Everyone, so this video is on financial plan. Financial plan plays a very important role in the overall business plan. So when you take your business plan to investors, they would put a lot of emphasis on the financial plan and use it to make a judgment whether they would like to invest in your company or not. Financial plan as such is very extensive, and I'm not going to go through a detailed financial plan. I would go into some key important aspect of financial plan that will help you in writing a short business plan. As such, we would learn the followings. We would first go through the basic of profit and loss statement. Then we will develop a profit and loss statement, and then we will determine seed capital and startup cost. And finally, we will look at all the financing options that are available for a startup. So how does a profit and loss statement looks like? A profit and loss statement looks something like this. It's in a tabular format. It's also called as income statement. On the first row you would have the year. So profit and loss statement are made year wise. You can also make it quarter wise. In this case we have year wise, and there are two sections of a profit and loss statement. One is the income section, the other is the expense section. So in the income section you have revenue, which is also referred as sales. You would have cost of goods sold, which is COGS. Cost of goods sold are direct costs that are related to making the revenue. So it would depend on the revenue, and it is also referred as direct cost. Gross profit is essentially revenue minus cost of goods sold. Gross profit margin, this is in percentage, and it is gross profit divided by revenue multiplied by 100. In the expense sections you have selling, general and administration expense. You have other indirect cost. Total expenses is essentially SGA plus other indirect cost. Net profit before tax is total expenses when you take it out from gross profit. So it is gross profit minus total expenses is equal to net profit before tax. Net profit margin before tax is equal to net profit divided by revenue multiplied by 100. So let's look at some profit and loss statement of three companies, and this is for 2014, and all numbers are in dollar millions. So the first company is Apple, which everybody knows. They make laptops, they make iPhones. The next company is Netflix, which makes their revenue through a monthly subscription fees, where you pay a subscription fees and you can watch videos and movies online. And Yodlee is a company that makes app, and they make apps for financial management. So if you look at revenue, the revenue of Apple is huge. It is $233.7 billion. Then is Netflix, which is $5.5 billion. Yodlee doesn't make as much money as Apple or Netflix. They make $89 million revenue. The cost of goods sold for Apple is also higher. It's $140 billion. Netflix, it is $3.75 billion. Yodlee, it is $35 million. So when you look at gross profit, which is revenue minus cost of goods sold, so if you take $233 billion and subtract, you minus it with $140 billion, you would get $93.62 billion. That is the gross profit. Similarly, you can do it for Netflix and you can do it for Yodlee. So the gross profit margin, which is gross profit divided by revenue multiplied by 100, so it is 40% for Apple, Netflix it is 32%, Yodlee it is 60%. So Yodlee has a much higher gross profit than Apple and Netflix, despite the fact that it has a less revenue. In case of expenses, you would have selling, general and administrative expenses. Obviously it would have much higher expenses for Apple and Netflix as compared to Yodlee. The total expenses is SGA plus other indirect costs. So in case of Apple it would be 14 billion plus $8 billion, so it's about $22 billion. And similarly you can do it for Netflix and you can do it for Yodlee. Net profit is your gross profit minus total expenses, so it is $71 billion for Apple, $403 million for Netflix, and in case of Yearly, they are actually making a loss. So if you take 54 minus 60, it is minus $6 million. Net profit margin is net profit divided by revenue multiplied by 100, so it is about 30%. In Netflix, it is about 7%. In case of Yearly, it is actually not making money, so it is minus 7%. So this way you can compare different companies. I've taken all these values from google.com/finance. So you can go to that website and look at any company that is listed in NASDAQ and you can get their financials. So let's take a minute and look at some companies in Google Finance. So I have already the website open. So if you look at, let's say, if you look Facebook, so you go to financials, and then I'm looking at annual data. And as I said, profit and loss statement is also called as income statement. So we are looking at for 2015, the revenue for Facebook was $17.92 billion. The cost of revenue, which is also cost of goods sold, is $2.867 billion. So if you take the cost of revenue from their cost of revenue from revenue, you will get the gross profit. So gross profit is about $15 billion, and they have XGA expenses of $4.2 billion. They have R&D expenses of $4.81 billion. R&D expenses is other indirect expenses. And if you look at the income before tax, it is $6.19 billion. So if you take this amount and divide it with the revenue and multiply by 100, that you would get net profit margin percentage for 2015 for Facebook. So that way you can do the calculation for any company you want to see. So if you, let's say, if you look at Microsoft, same thing. If you can go to financials, and if you go to the annual data, Microsoft had a revenue of $93.58 billion in 2015. Their cost of goods sold was $33.03 billion. They had a very good gross profit, and their income before tax was $18.5 billion. So this way you can look at different companies, and if you look at this plot basically shows their revenue and net income. Revenue is in blue net income is in yellow, and your profit margin is in red. Okay, so now let's get back to the presentation and let's go through the different terms and terminology once again. So as I said, revenue is also known as sales. So it is the amount of sales that a company makes for a given year, and cost of goods sold is the direct cost that is related to making that revenue. So this is little tricky to understand, but let's look at suppose a company is making pen, and in case of pen, the things that you need is you need plastic cover, you need ink, you need spring, and you had other plastic parts. So the cost of all this component plus the labor are directly related to the sales of that product, and that is referred as cost of goods sold. And gross profit is essentially revenue minus cost of goods sold. Gross profit margin is gross profit divided by revenue multiplied by 100. SGA is an indirect cost. So SGA are costs that a company incurs related to selling, general and administration, even if they don't make sales. So these are some of examples are, let's say, rent, insurance, marketing cost, administration cost. Net profit is basically your gross profit minus all the indirect expenses, which are the GSA and other indirect costs. And net profit margin is net profit divided by revenue multiplied by 100. So now let's start building an income statement. So let's look at a company. The company name is X, and they are developing a pen which lasts forever. So they have a pen that never runs out of ink. And the founder of this company believes that it will take another 2 years, so 2016 and 2017, before they can actually start selling the pen. So there would be no revenue for 2016 and 2017. Also, they have determined that the average selling price for the pen would be about $2 per pen. So now let's use this information to build a profit and loss statement using an Excel sheet to create the profit and loss statement for company X. So I have a table here. So we have income section, we have expense section, and this is profit and loss statement for 5 years. So it's 2016, 17, 18, 19, and 2020. So let's first look at revenue. So I have a small table here for revenue calculation. So we have number of units sold, average selling price, and revenue. So we know the average selling price, so let's input $2 per unit, and let's keep it constant for the 5 years. And the number of units sold, so they are not going to sell anything for the first year and second year because they are developing the product. And third year, let's assume that we would sell 500,000 pieces, and then let's say 2 million in 2019, and let's say 5 million in 2020. So now if we multiply the number of units sold with average selling price, we will get the revenue. So there is no revenue for 2016 and 2017, but you would have revenue for 2018, 2019, and 2020, right? So you would have $1 million revenue in 2018, 4 million in 2019 and 10 million in 2020. So this would go to your profit and loss statement. So I'm just putting the formula for the revenue here. So now we have for the revenue. The next thing is cost of goods sold. For this I have another table. For COGS, so here we have the number of units manufactured, then the raw material price breakdown, and number of employees we would have, salary per employee, and other other direct cost per unit, and then would be the total COGS. So the number of units manufactured is, let's say, is equal to the number of units sold, right? So we copy it for 2017, 2018, 2019, and 2020, and then let's look at the raw material price per unit. As I mentioned, in case of cost of goods sold, you look at the direct cost. So direct cost is raw material and labor. So the plastic body, let's say it is 20 cents per piece, and let's say the spring is 5 cents, and let's say the ink is 25 cents, and if you sum all these three, then you would get the raw material price per unit. And let's say the raw material price remains same for the next 5 years, right? And same way we can calculate the total raw material price for 2017 till 2020. And then is the labor part. So you would have essentially no labor in manufacturing for 2016 and 2017, but you would have some labor for making 500,000 units in 2018. So let's say it is 2, and let's say 4 people in 2019 and 9 people in 2020. And let's say the salary is per employee is $50,000, and if you look at total salary, that would be number of employees multiplied by salary of per employee, and the salary will go up for 2018, 19, and 2020 because you are actually manufacturing. And there would be some other other direct cost per unit, and let's assume it is just 2 cents per unit. If you want, you can actually break down the other direct costs as well. So the total COGS would be the salary plus the raw material cost per unit multiplied by the number of units manufactured, plus you would have the other direct costs multiplied by number of units manufactured. So COGS is nothing for the first year and second year, and then it will increase. Now we will have to input that in the profit and loss table. So I'll go back to the profit and loss table and essentially input that values. So gross profit is revenue minus your cost of goods sold. And if you put that for different years, you would see that the gross profit is essentially increasing with your sales volume. And gross profit margin is gross profit divided by revenue. So in this case, if you have zero revenue and zero cost of goods sold, so you have nothing, so gross profit would be 0%. And 2017 also it would be 0%, but it would, sorry, it would increase for 2018, 2019 and 2020. So we now have the income section completely done. Now let's move on to the expense section. So let's first look at the SGA. First now to SGA. Look at the SGA part. So SGA are indirect costs related to selling, general and administration. So some examples are rent, marketing and advertising costs, salaries that would go for, let's say, marketing and your administrative purposes, insurance, legal expenses, accounting, utilities, telephone, internet, office supplies, travel, and there may be some additional item. So I have already filled this table and we'll just sum all the values. And then we will input those values on the profit and loss statement. Okay, now let's look at other indirect cost. Look at, okay, now let's get into other indirect costs. So for this company, the other indirect cost is typically the R&D cost. So they have to develop the product. So let's say the first year it is $40,000, and maybe this is the cost for the second year as well. For third year, let's put $100,000. Then maybe $100,000 for 2019 and $100,000 for 2020. So the R&D cost will depend from company to company, and you can also have a breakdown of the R&D cost. I've made it simple and I have taken some numbers so that I can use it as an example. And let's use the input into the profit and loss statement. So this would be equal to your total of other indirect cost So now if you look at the expense section, we just have to do some calculation. So total expenses is basically sum of SGA and other indirect costs. And net profit is essentially your gross profit minus total expenses. So you would be making a loss in the first and second year because you don't have any revenue, and then you would make some money in 2018 and the profit would increase to significantly in 2019 and 2020. And net profit before tax is, sorry, net profit before tax margin is net profit divided by percentage. And in the first case, you are not making any revenue, so there would be nothing in the first year, nothing in the second year, and then in the third year you would have a net profit of 19%. For 2019 it would be 39%, and then it would increase to 48% in 2020. So that is how you develop a profit and loss statement. So these are your financial projection for 2016 till 2020, and you use this profit and loss statement in your business plan. The profit and loss statement for company X. So I would copy the table and paste it in the PowerPoint presentation. So now this becomes your profit and loss statement for company X, and as you can see that the company is not generating money in 2016, 2017, 2018. It has a revenue and it is actually making some profit. In 2019 the profit gets increased to $1.5 million, and 2020 the profit further increased to about $4.8 million, and the gross profit also increases from 64% to 70% between 2018 to 2020, and net profit increases from 19% in 2018 to about 48% in 2020. So this is how you develop a profit and loss statement. Now let's look at the seed capital and startup cost. First of all, what is a seed capital? So seed capital is funding that is required to get a new business started. So it is not that you would need all the amount of money before you make profit. Seed capital is essentially the amount of money that you need to get a business started. So it is typically costs such as market research, product development, business plan development, and it is actually a very small portion of the startup cost. It can vary from company to company, but typically it's between $25,000 to $50,000. Some cases it can go to few $100,000. Startup cost includes seed capital and other money till the company actually generates profit. So if you go back to the profit and loss statement of company X, a startup cost would include the expenses of 2016, 2017 and some portion of 2019. It will also include one other thing that is not in the profit and loss statement, which is the equipments. So we are having a profit and loss statement based on before tax. So we don't account for something called depreciation and amortization. I don't want to complicate those things, but keep in mind that the equipment that you would buy for making this revenue doesn't get reflected in profit and loss statement, and you have to use the startup cost to pay for that equipment. So I will come into that in the next slide. Basically, how would you calculate the startup cost? So when it comes to seed capital for this company, it would be, let's say, about $50,000. So the seed capital is $50,000. Now, if you look at the startup cost, as I said, you have to add the first year loss, second year loss, and the capex cost. So the first year loss is 152,250. Second year loss is 148,250, and that comes to $293,500. But then you have to also add equipment cost, and you need some money in 2018 to run the business. So let's assume that you need about $200,000, which would be sufficient to operate the first quarter and some part of the second quarter of 2018. So if you add the first year loss, second year loss, which is $293,500 plus $200,000 that you need for 2018, and the equipment cost, which is also known as capex, which is capital expenditure. So it comes to $493,500 plus the equipment cost. Now, equipment cost for, let's say, 2016 is $25,000, 2017 is $25,000. Then you add the capex cost for 2016 2017 with $493,500. You don't add it for 2018, 19, 20 because you would be generating revenue in those years, so you don't have to raise that amount of money. So if you sum it up, you will get $543,500, and that is the startup cost. So company X has to raise that amount of money for this profit and loss statement. Okay, now let's look at what are the different ways a company can raise money. Before that, one has to understand that there is not one stage of financing, but there are multiple stages of financing. So for company X, they don't need a lot of money. They need about $550,000. For those kind of company, it might be good enough to go through one round of investment. But typically, company goes through multiple rounds of investment. So the first stage of financing is referred as some seed stage, and then it is referred as early stage or series A, and then you can have multiple series to initial public offer. Now in seed stage, you essentially raise about $50,000, maybe sometimes $100,000. So you don't raise a lot of money in the seed stage, and typically the sources of funds for the seed stage are mostly friends and family, and it is mostly in the form of paid debt, and I'm going to explain what is the difference between debt and equity. In case of early stage, you raise up to $2 million, and you raise from angel investors or venture capitals. In later stage, you can raise more than $5 million. And early stage and later stage investment are typically equity investment. So the difference between a debt and a equity financing is debt is essentially a loan. So you don't give up the ownership of the company, and you basically pay the money to the lenders once you start making money. Whereas in case of equity, you give some ownership in exchange of investment they would make to a company. So for company X, as I said, they don't need a lot of money, so they can go through a seed stage, which means they can raise up to $50,000 from friends and families, and they would go for a, let's say, a Series A, which would be about $500,000. So this completes our financial plan presentation. So if there is any questions, you can send it to info@kalingaventures.com.